Hey guys, welcome back to Father and Son Investing. It's a Saturday, so no tie for me today. Today is going to be another update on U.S. Treasuries because, again, we saw a significant bump up in U.S. Treasuries yesterday. Look at this little spike that occurred in the morning. What happened yesterday? Well, it was the producer price index that came out. So we're looking at the wholesale numbers there, and they came in greater than expected. Here is what the numbers look like. We're going to borrow this article from Barron's. Here's the headline: Inflation runs hot again, complicating matters for the Fed. For the month of January 2024, the producer price index increased by 0.3%. Well, what does that mean? The expectations were for 0.1%, so definitely higher than expected. When we dig into the numbers a little bit, goods prices actually declined by 0.2%. So what is driving this increase? It's demand for services. It moved up by 0.6% in January. When we look back at the CPI numbers that came out earlier this week, we'll also see that it was services really that was driving the inflation. So this is where the Fed really has to try to get this under control. It's services and housing that are really driving inflation right now. Now, one reason that we care about the PPI data is that it feeds into the calculation of the Fed's preferred inflation gauge, the Personal Consumption Expenditures Price Index, otherwise known as PCE. The PCE data will come in on February 29th, and what are the projections for this? I'm going to turn to my favorite webpage for inflation forecasting, and that is the Cleveland Fed's Inflation Nowcasting website. We're going to look at PCE and core PCE predictions for January. They're saying the PCE, they predict 0.26 month over month and 0.32 for the core PCE. Remember, core strips out energy and food, which are very volatile. But turning back to this article in Barron's, Citibank's chief economist projects that the core PCE will go up 0.4% on a month-to-month basis. Now that's up from 0.2% in December. Other projections also reflect that 0.4% coming in from Bank of America economists. They also say PCE 0.4% is their projection. Looking even more into these projections, going to something called Supercore PCE. Now that takes out energy and housing. The Citibank economist is projecting 0.55%. Why is that important? Because that would be the strongest since March of 2022 and potentially a warning indicator for persistent stickiness of services inflation. Now, why am I telling you all of this? Because those PCE numbers will be coming in on February 29th, so just about 2 weeks from now. And I would expect that when they come in higher than originally anticipated, we just might see another one of these little spikes here. This is the spike from the CPI data that came in. This is the smaller spike from the PPI data that came in. And if that PCE number comes in like they're now anticipating after these two reports, I would expect to see a similar bump up in yields that we saw for the CPI numbers. So if you're anticipating buying U.S. Treasuries, at least the notes and bonds, you potentially could expect to see a little bump in the yield that you can get at the end of the month. These numbers that came in for the PPI really didn't affect the Treasury bills so much the way that they did with the CPI numbers earlier in the week. So what would I expect for the rest of the month of February when it comes to Treasuries? We'll just use the 10-year note as an example. I would expect that this is going to drift downward. We see after the CPI report that there was a drift downward followed by that quick spike upward with the PPI report. I would expect that we're going to see a similar drift downward as we get towards the end of the month, followed by a spike again with the PCE. I don't anticipate that spike is going to be as big as either the CPI report or this was the blowout jobs report where it really took a big jump. Just going back to around the 30th of January, we were sitting at 3.9% roughly on the 10-year Treasury note, going all the way up now to 4.3% within less than 2 weeks. Where would I anticipate the PCE report getting the bond yield to on the 10-year? I would anticipate somewhere in the 4.35% range. I don't think it's going to get to 4.4% just because I anticipate we're going to see a drift downward in the yields during those 2 weeks. There is one other report that's going to come out next week, and that is going to be the existing home sales data. If you're not familiar with that, that comes from the National Association of Realtors. This is what that home sales data looks like. It tends not to move markets much, but it does give us an indicator of when we could be heading towards recession, when we start seeing home sales going lower and lower and lower. So it'll be interesting to see what these numbers come in at. I think the estimate that I saw was somewhere in the range of 3.9 million, so potentially going up just a little bit. One interesting thing in this data from December, we'll wait to see what the January data shows. You'll notice the trend going up here in terms of the median price percent year over year. When the Fed is looking at housing, this certainly is something that can play into that, because housing certainly takes a big chunk of that CPI data. And if this continues to go up, well, then we could expect to continue to see housing keeping those inflation numbers up, and thus reducing the odds that the Fed is going to be lowering interest rates. In the past, I've shown you the CME Watch Tool website and their predictions for Fed rate cuts out into the future, how those have been being pushed further out into the year as this economic data comes in. There's an interesting graph here in the Wall Street Journal from yesterday that also gives you an idea of how this has been changing. This here in the dotted red is what was expected for Fed rate cuts out into the future 1 week ago. And now, after this data has come in for the CPI and the PPI, you can see how this curve has significantly changed looking out into the future when it comes to Fed rate cuts. Of course, the Fed funds rate not only affects your Treasury bill yields, short-term U.S. Treasury yields, but also has significant effect upon your Treasury note and Treasury bond yields. Knowing that the expected Fed funds rate decrease is now being pushed further out into the year, that should help keep the yields on your U.S. Treasuries higher than they were expected 1 week ago, and should keep that drift that I talked about on the 10-year Treasury note and really on all of those other Treasury notes and bonds, should help keep that drift downward from going too low. I don't expect that we're going to see it dipping down below 4%. Now, these recent increases in U.S. Treasuries yield continues to put the Treasury in a bit of a bind or a squeeze here. I've told you before how the Treasury is purposefully keeping the auction sizes down on the 10-year note, the 20-year bond, and the 30-year bond. And you can see the numbers here, and also how they've been increasing the auction sizes on these shorter-term notes. And that is an effort, particularly by the Treasury, to keep the yield down on those longer 10-year, 20, and 30-year U.S. Treasuries. Nevertheless, the yields are continuing to rise, and at some point the Treasury has to go back to regular size 10-year, 20-year, and 30-year auction sizes. And when they do that, it's going to drive yields up even higher on the 10-year, the 20-year, and the 30-year. In my opinion, that might have Janet Yellen. Houston, we've got a problem. I hope this information was helpful for you. If it was, please give us a thumbs up. And until next time, enjoy your investing.